What company has been paying dividends for 150 years straight? Stick around to find out. How's it going, everyone? Welcome back to Who Beat the S&P 500. Got another episode for you all today. This time going to be in the financial sector. As of late, this sector has been thoroughly beaten down due to the low interest rates, and there are some very good opportunities out there, especially the company we will be discussing today. Let's get right into it. Today's company was founded in 1864, making it one of the oldest financial companies, not in the US, but for the first time in this series, across the border in Canada. Let's see how the company fared against the S&P over the last 20 years. Had you invested $10,000 into this company exactly 20 years ago, with dividends reinvested, you will be sitting on a grand total of $114,697.19 versus a $30,084.52 of the S&P. That's a fantastic 1,046.22% total return, over 5 times that of the S&P at a good rate of 12.97% average annual return versus the 5.54% of the S&P in the same time frame. Overall, comfortably beating the S&P. So what company, which is considered one of the big 5 banks in Canada, are we going to be looking into today? It is Royal Bank of Canada, currently the largest bank in Canada. Royal Bank of Canada, or otherwise referred to as RBC for short, is tradable on most US brokers, if not all of them. The company is a member of the S&P/TSX 60 index, which is an index of the 60 largest companies listed on the Toronto Stock Exchange. RBC has a market cap of almost $98 billion, currently making it the second largest company in Canada by market cap after Shopify, which recently displaced it from the top spot. RBC trades with the ticker symbol RY and resides within the financial services sector. Alright, when looking at the dividend for RBC, this is where things get interesting. Well, as interesting as it gets for dividends anyways. RBC currently has a dividend yield of 4.60% at a payout ratio of 60.7%, which is a bit high, probably a lot higher than usual as their share price has dipped recently. Amazingly, RBC has been paying dividends for 150 years straight. So you know you'll be getting something from them every year, but the question is, how much? Normally, I use Seeking Alpha, which is an excellent source for looking at dividends, but this time we find something peculiar. We can see that RBC has only raised their dividend for 4 years straight, with dips in 2015 and 2016, as well as dips during the Great Financial Crisis in 2008. This is actually not accurate. So what's the problem, you might be asking? Well, it is important to note that Seeking Alpha reports in USD, not Canadian dollars, and what they're not accounting for is the price fluctuations between Canadian dollars and US dollars, which changes almost every single day. So, in this instance, it's actually better to go directly to the RBC website and look at their dividend history. Here, we can see that not only did RBC neither cut nor suspend their dividend during the Great Financial Crisis, but even maintained it. Also, they have pretty consistently raised their dividend since 2010. Finally, when using an online CAGR calculator, we get about a 7.36% compound annual growth rate over the last 10 years, which is solid. RBC has a very stable dividend yield, with no cut during the Great Financial Crisis, and with 150 years of payments, you can almost guarantee some sort of dividend for as long as this bank continues to exist, perfect for any dividend portfolio. Also, always keep in mind, it is important to double check information and compare multiple websites for all stocks, and especially for stocks that deal in foreign currencies. When we look at the revenue streams, please note that all numbers will be in Canadian dollars, and RBC's fiscal year starts in November of each year and ends in October. Banks deal with 2 different types of assets: assets under administration and assets under management. Assets under administration is defined as a total of assets for which a financial institution provides administrative services and charges a fee for doing so. Whereas the second type of assets, which are assets under management, is the total market value of the investments that a person or entity manages on behalf of the client. Banks primarily generate income through interest on the money they loan out and through various services that they offer, which is broadly defined as non-interest income. Going by their 2019 annual report, we can see RBC generated $46 billion in the fiscal year 2019, an 8% increase year over year. When looking at the chart from 2016 to 2019, we can see a steady upward trend in both revenue and earnings. RBC's income is separated into 5 main business segments: personal and commercial banking, capital markets, wealth management, insurance, and investor and treasury services. Starting with personal and commercial banking, which makes up 45% of revenue, of which 71% of that revenue being from net interest income and the remaining 29% coming from non-interest income. We can see that this segment is further broken down into personal banking / business banking and Caribbean and US banking, with personal banking making up most of the revenue. This segment makes money by providing a broad suite of financial products and services to individuals and businesses for their day-to-day banking, investing, and financial needs. The capital markets segment makes up 21% of overall revenue, with revenue being split 50-50 between net interest income and non-interest income. This segment generates income through their global investment banking services to corporations, institutional investors, asset managers, governments, and central banks around the world. The wealth management segment makes up 20% of overall revenue, with 25% of that being net interest income and 75% coming from non-net interest income, which makes it less likely to be affected by the current low interest rates. This segment currently has around $1.06 trillion in assets under administration and $756 billion in assets under management. Revenue is generated through selling their investment, trust, banking, credit, and other products to high net worth individuals or individuals with over $1 million in assets, and ultra high net worth individuals, which are individuals with over $30 million in assets. The insurance segment makes up 6% of overall revenue, with 100% of revenue being non-interest income. This segment generates income through various insurance products such as creditor, life health, home, auto, etc. These products are distributed through their various channels ranging from RBC insurance stores to digital and online marketing. The investor and treasury services segment makes up the last 4% of revenue overall, 100% of which is non-interest income. With $4.3 trillion in assets under administration, RBC provides cash management, transaction banking services, as well as treasury services and liquidity for client assets to generate income through this segment. With the majority of their clients based in North America, primarily in Canada, with a decent amount in the United States, RBC has been pushing to maintain their top status in Canada every year, along with continuing to make inroads in the global scene. They have a huge emphasis on pushing digital solutions, especially mobile, and further streamlining the user interfaces to better benefit their customers. Now, let's see how the company fared in the dot-com bubble crash, the Great Financial Recession, and how it's currently trading in the downturn in 2020. RBC fell 42.46% during the dot-com bubble crash, a little less when compared to the S&P's 50.41% decline, RBC edging out the S&P by about 8% here. When looking at the Great Financial Crisis, RBC crashed 65.49%, falling about 8% more than the 57.61% decline by the S&P. The S&P performing better here. During the downturn in 2020, RBC fell 40.16% compared to the S&P's 35.59% decline, falling more than the overall market and recovering slower as well. This has been pretty consistent across most of the financial sector in the calendar year 2020 so far. Headquartered in both Toronto and Montreal, Canada, RBC currently has around 85,000 full-time employees in over 1,300 banking branches worldwide, with the majority in North America, primarily in Canada. RBC has been led by CEO Dave McKay since August 2014. McKay leads a management team of 10 executive officers overseeing the company, many of which have been with RBC for numerous years, with the most recent addition being Rod Bolger, their CFO, who joined the company in 2011. McKay himself has been with RBC since 1983 and has spent his entire career there, starting as a co-op student in computer programming before moving up the management ranks throughout the years. With originally being from the computer science scene, McKay has been a huge proponent of tech advancements at RBC, which has served them very well in the future. Taking a look at stock performance since McKay took over in August 2014 shows us a decrease of 9.5%, which is surprising and a bit disappointing for potential investors. Currently leading all institutional shareholders in owning RBC stock is none other than RBC itself at a 5.38% stake, followed by Rival Bank of Montreal at 4.26% and the Vanguard Group coming in at third with a 3.14% stake. TD and FIL make up the fourth and fifth places. What's interesting is that 3 of the top 5 spots are made up of Canadian banks, and that there are actually several reasons for this. If you're interested in more information on this subject, I've linked a very good article by the Huffington Post in the description below. In my opinion, With a decorated history and a strong central banking system in Canada, RBC is set up for success. The 150 years of dividend payments speaks for its longevity and commitment to shareholders. Though nothing is guaranteed, the chances of RBC suspending their dividend is slim to none. With interest rates being close to zero in 2020 and set to remain the same for the next few years, RBC has been positioning itself to generate more income from their non-interest businesses, which totaled around 57% of all revenue in fiscal year 2019. They have also made a push for digital and technological advances in their services, giving the company more breathing room in such environments. Add all that to a management team that has been with the company for most of their careers, and you have a solid company overall. The biggest concern a potential investor might have is that the stock price hasn't really gone anywhere, but to counteract that, dividends and revenue have been steadily increasing. That wraps up our analysis of RBC. As always, thanks for watching, guys. I hope you were able to take something away from this. Drop a comment below with your thoughts on Canadian banks. Till next time, Stock Ninja, out. I am not a financial advisor, and this video is for educational purposes only. Please do your own research before buying or selling any stocks seen in this video. Thank you.